Now let's have a look, for example, when you combine these two strategies. 17th of August sold like this last screenshot, but I just wanted to show you YNDX for 24. So it's 1 week put, okay, with a strike price of $32.50. We get $1.30, $250 we received. Then it was assigned. So the share price dropped, like exactly you're asking, right? So it's dropped. We bought shares at $32.50. I didn't roll it over. I didn't want to. The share price, I believe, dropped close to $30, something like that. So then what I did is, look, I bought shares on the 24th of August. I was waiting a couple weeks, and then I sold the call again for 1 week only with the same strike price, $32.50. Exactly the same. The price I bought, I promised to sell at the same price. I got 75 cents. It's expired worthless. Then it expires lossless on the 5th of October. On the 9th of October, I sold another call for 12th of October, and I received $1.10 here, $230. So, and then my shares were taken from me. So, look, I bought shares at $32.50, and I sold them at $32.50 at the same time. Altogether, if you calculate the duration, it's 2 months. So the total profit, 1.375, $1.10, and divided by our investment, $32.50, it's 9.6% in 2 months. Now, I was showing you the profitability of Walgreens Pharmacy and Holy Frontier. This volatility recently. At the moment, you can get much more premium than last year. That was last couple of years ago when the volatility wasn't that high. For the last few years, you could get from options roughly 2 to 3, maybe 4% a month. Okay, so if you just sell monthly call options on a weekly, if you sell the weekly options, you might collect a bit more. But right now, you can get 7, 8%, sometimes 10% on this. So this time, this specific year, it's a fantastic year for option traders, for all traders, because the volatility is very, very huge. I'm going to show you later how big is it. Okay, in case you need to have funds, now the penny just dropped, I think. So the seller pays you to promise to buy at the price. This discounts you buying price also. All right. The third strategy. Okay, guys, can you put from 0 to 10 how you understood this strategy, at least an idea of it? I don't expect that you understand everything clear in details. I mean, the put option strategy. But the questions you ask, very good. I mean, I really like them. It means that you're thinking ahead what is going to happen in the future. Fantastic. All right, another option, another strategy is buying leap calls. Now, so we're buying calls. In order to I'm going to go a bit back, just a second, somewhere here probably. Now we're looking at this side. We know the risk of losing all the money here in this particular case. How we can reduce this specific risk? If we sell, if you buy for 2 days, or you buy for 10 days, or you buy for 1 month, or you buy this option for 3 months, where is the higher chance that the price moves up, is going to move up? So what duration would you choose if you buy an option? Where do you think the higher chance that the price will move into your direction? Correct, Rick. You see, we have expert here. So the longest, the better. Because the price in a short period of time is very volatile to the emotions, to the market. Donald Trump can tweet something and that's it, the market is affected. Okay, Chinese president can tell something, that's it, the market is affected. Okay, something happens with the oil prices, the market is affected, but in the short term. So if you know that the company is good and you decided to buy option on that instead of buying shares, but you need to buy a longer period. Usually we buy 6 months or more. And in this particular case, okay, in this case. So when we buy long term. So we buy for 6 months, 9 months, 1 year, 1.5 year, depends on the premium which we can get it. So let's have a look. One of the example. It's a screenshot from the account. 24th of August. Okay, there was bought CVS Health 80 call, and it was paid $3,150 for that call. Few days later, 6th of September, so it's only what, 13 days, we sold it for $4,020, and we got $870 pure profit. 13 days. Even though we buy call until 6 months from now or 1 year from now, we don't hold it that long. The reason, do you remember when you ask that different melting time, melting premium, during the last month, the premium melts very, very quickly. When you buy for 1 year, for the next 10 years, if the share price is going to be on the same level, the premium reduces very, very little, very small. So you don't lose this time as a premium. And then what you do when the share price moves, you sell it. Okay, this is how the LEAP option works. Also, when we buy LEAP calls, we also analyze the company. The company has to be good, it has to be undervalued, and has a potential to grow. Okay, same criteria which we use when we buying stocks for call option. All right, guys, can you put please from 0 to 10 how you understand this strategy? I'll just show you another example. Guild, same story, 3rd of January and 26th of January. So it's 20 days trade, and 7,000 put, 14,000 sold, $7,000 in 23 days. So it's like 100% return on investment. Now, about this strategy, I'll tell you one thing. This strategy is very attractive. It's very profitable. And a lot of people who start, they're tempted to go there. The risk is here 100%. So whatever $7,000 I put here, I could lose this $7,000. Okay, so I have to understand that initially, because if the market stays below or company comes with the problem, if I buy shares, it's not a problem. If I believe the company in the long term is going to recover, I would say take a year or two, it's still going to recover. I will get dividends during that period of time. This contract is going to expire. Okay, so that's the risk. Usually when I trade, I allocate only a small portion of my portfolio to these risky trades. And usually I don't use my own capital. The way you trade, for example, you collected, you bought shares on another security, you sold call, you got, let's say, $5,000 from that. You take $2,500, so half of the profit which you already received from another trade, and you put it in this risky trade. And if it works for you, great, you increase your total profitability. If it doesn't work for you and you lost this $2,500, you didn't use your own capital. You used the profit which you already received. Yes, your return on investment now totally on the whole account reduced, but you don't lose your own money. It's very, very important part. Okay, guys, put from 0 to 10 how you understand this thing, because for us, always focus on the downside. You focus on profit, but keep in mind our downside. You have to always kind of think about total long-term investment. So okay, so it means that you, for example, you put $100,000 in a trade, right? And $50,000 you use to buy one share, $40,000 to another share, and then from this $90,000 you sold the call and you got $4,500 rental income, right? You receive $4,500. Then you take $2,000 of this, and then you put it into the trade like that. Okay, UG, I don't know if you understand it or not now. But again, we're going to explain it in more details. That's, for example, our retreat. We went to one of our retreats. This one was in Turkey, this in Thailand. This is also in Turkey. That's fantastic, absolutely time. What we do during those retreats, it's a lot of psychology there, a lot of trading strategies. People who come to these retreats, they usually know how to trade. They know specific, they have own accounts. And what we do, we analyze companies, we find companies there, and we trade these companies. So one of the guys here sitting here, he already went through education, he opened the account, but he didn't trade. It's first trade, and he sent me the screenshot after that with his income. He said, look, one trade he made, he put $1,700. He bought call for WBA, the company which we look today, and he made $942. So 55% return on investment. He's done 2 trades. He totally covered his cost of his retreat. While he was at retreat, he paid off the cost of it by doing these trades. This is another trade, also ETFC. You can see how we use technical analysis. So that was our masterclass. The masterclass, it's analytical masterclass. I don't know, guys, have you been to our last masterclass? Because we opened it to the public. I don't know if you had a chance to look at this. And the way we work, so we run a masterclass and we prepare the company and we analyze different trading strategies there. Okay, and then you can place this trade. It's already up to you. You can use the same company, you can use another company. So what happened? So this was the master class, and that was the trade, and that was the exit of the trade. So it was exactly done like we predicted during our master class, and that was the profit. If we traded options, we would make less money. I know actually it's a share trade. No, lip call. This is lip call. So we bought for $2,300 and we sold for $2,700 and we collected $368, which gives us 15% return on investment. Okay, within a very short period of time. So okay, that was 1 month trade. So that's actually after each master class. We keep an eye on what's happening. So, and we record the trades which we do. In some cases, you can see it's very tiny profit, 1.7%. Usually it's conservative strategy. These are aggressive strategies. They buy in calls. This is conservative strategy, maybe neutral strategies. This is aggressive strategy, we buy call and short call. What I want to tell you also, this year is very interesting year. I've been trading for nearly a decade, and I've met so many traders, and practically every investor, every trader tells me, you know what, Igor, I would love to be in 2008 because now I know what to do. I would buy all the companies because every company practically like increased 3-5 times, some companies 10 times from that level. This year is going to be exactly the same. It's already showed us first drop. We had the first drop, but it's more like an emotional drop. Now the companies is getting into liquidations. I got just report one of the retail company, Ascena, is going to be into bankruptcy. A lot of avia companies will go down. There would be hotels going down. Cruise liners will go down. A lot of industry will go down. And the stock market will be affected by that. And look at this, how hugely it was affected. Like I took this screenshot. There are good companies here, and look at the move. This is a stock. It's not even share and options. 32% in one day, 25% in one day, 16. So huge movement. We're going to see a similar move down and then up again. And if you want to profit from that, if you don't, because at the moment, traders, they make money within a month, which they usually make during the year. I analyzed the banking profitability. I thought banks will go down because people businesses going into liquidation, not paying. But banks now, investment banks, they make money on trading because this is a unique opportunity where you can make so much money in trading. So guys, if you're already trading, use this time, okay? If you don't trade, learn how to do that and jump on a board, because that's kind of the best thing which you can do right now. You can, within this year, you can create the income for the next couple of years or so, something like that. All right. So look at the option premium, how it changes within one day. So this is 23rd of March, right? So it was $2.30. This is a Harley Davidson call option, $2.60 here and $5 next day. So you can double your money within one day. Okay, and that would be with put options. On another side, same company, but if you're going already puts, $5 put, and the next day it's $2.10. So you sold put here, you bought it back here, and you made the money on that particular case. This is a list of kind of most popular probably trades. It could be extended to even more. And every time you ask me what strategy do I use, how to use volatility, etc., there are different traders on the market. Some traders, they learn one strategy and they use this strategy and only that specific strategy. The way they use it, so they constantly look for new companies when like implement certain strategy, right? So for example, buy and call or sell and put, and they require certain volatility, they require certain duration, certain premium, etc., right? My approach is a bit different. So I find the company first. I find underlying security, for example, WBA, or I find YNDX, or I find Newskin, or I find something else, right? So Pfizer, and I find this company, and I see that this specific business has a potential to grow. And after that, when I find the company, analyze the company, and I'm happy with this business, and I'm happy with the price, I start thinking, which strategy do I use? Do I use sell puts? Do I buy calls? Do I buy shares and sell calls? Okay, and I use one of these strategies, okay, when the market is, for example, bullish. At the moment, I believe that the market is going to go into reset. We will see the second wave. So I'm going to use bearish strategies. And again, when I find a company which is suitable for shorting, I start thinking, okay, fine, is it high liquidity or is it high volatility on the market? What can I get? What premium? So if the premium is high, I would be selling options because I get a lot of premium on it. If the volatility is low, so I will buy options. Okay, I think Rick, for Rick, I make sense right now. For a lot of people, kind of it's different. So when you have the option what to choose, it's much easier for you guys. Okay, that's why we have this education. We explain practically all the strategies. So and you can see you can make money bullish. So when the market goes up, you can make money when it's bearish. So when it goes down, you can have neutral strategies, right? Or you can have event-driven strategies. So you base when the certain event is going to happen. Or you can stock combination strategies when you combine shares and the options together.